What if the most celebrated milestone in middle class finance is actually a design flaw? Let's think like engineers for a second. If you were designing a financial system for your life from scratch, like building a rocket or a new operating system, would you prioritize eliminating a liability or maximizing optionality? Because that's what this really is, system design. Most people design their financial life around emotional relief, the wealthy design around asymmetric upside. Now imagine two parallel universes. In universe A, you aggressively pay off your 4% mortgage every spare dollar. You cross the finish line early, no debt, applause. In universe B, you keep that mortgage. You redirect the extra cash into productive assets, compounding at, say, 8 to 10% over decades. Same discipline, same income, different architecture. Fast forward 25 years. In universe A, you own a house free and clear. In universe B, your assets may dwarf the remaining loan balance. Which system scales better? That's the question. Paying off a low rate mortgage early is mathematically equivalent to locking in a guaranteed return equal to the interest rate. If that rate is 3 to 5%, that's your ceiling. But markets, productive businesses, innovation, global growth have historically compounded at higher rates over long horizons. So what are you really doing? You are choosing certainty over scale. Now, here's where most conversations get shallow. People say debt is risk. But in advanced finance, risk is volatility combined with illiquidity. When you send extra principal to the bank, that capital becomes trapped equity. It stops being adaptive, it stops being strategic, it becomes static. Liquidity is strategic energy. It allows you to pivot industries, launch businesses, survive recessions, exploit crashes. Equity in walls does none of that. Now let's talk inflation, the silent co-founder of every long-term mortgage. When you lock in a fixed 30-year mortgage, you are freezing a nominal payment in time, but inflation reduces the real value of that payment every year. If inflation averages 3%, then in 20 years your payment feels dramatically lighter relative to income and prices. You are repaying the loan with progressively cheaper dollars. That's not an accident. That's financial physics. Paying it off early is like prepaying a 30-year subscription to something that naturally gets cheaper over time. Now zoom out further. The most powerful concept in wealth creation isn't debt elimination, it's capital allocation. Where does your next dollar work hardest? Inside drywall at 4% or in productive assets compounding globally? This doesn't mean debt is universally good. If your mortgage is 8 to 9% in a high rate environment, eliminating it may be rational. If you lack investment discipline, forced amortization may protect you from yourself. But for a disciplined investor with a low fixed rate, the mortgage can function as inexpensive leverage. And leverage, when paired with productive assets, accelerates wealth creation. There's also a psychological trap. People imagine that once the house is paid off, they will suddenly invest aggressively. But behaviorally, freed cash flow often expands lifestyle rather than net worth. The discipline must exist regardless of the mortgage. So here's the reframing. The goal is not to be debt-free. The goal is to be financially anti-fragile. Anti-fragile means shocks make you stronger, not weaker. That requires liquidity, scalable assets, and intelligent leverage. A paid-off house is stability. A diversified investment portfolio that overwhelms your liabilities is dominance. So instead of asking, how fast can I eliminate this mortgage? Ask, how fast can I build assets so powerful that this mortgage becomes irrelevant? That's a different mindset. That's systems thinking. That's long-term capital design. If this perspective upgraded the way you think about money, subscribe. We're not optimizing for applause. We're engineering freedom.